Yo, what is going on, guys? Bexio back, and today we've got a brand new video on the stock market and getting involved in investing and the best possible ways to get involved in the market. We've seen the market go from its March lows where it absolutely collapsed and circuit breakers going off and everyone freaking out to where it rallied to today, and everybody who's involved made a bunch of money as long as you invested in certain things. I mean, recovery stocks didn't do too well, so if you were only in those, I guess you didn't make a bunch of money, but you know, the majority of people really did. So now a lot of people are interested in getting involved in the market, getting involved in investing, putting their money to work, and it's great to see, but it can turn you away getting started if you go about it the wrong way or the risky way, where you either make a bunch of money or lose a bunch, and that's not going to help anyone. If you lose a bunch of money, they're never going to want to be investing again. So I'm going to cover things that I did personally and things that I think are the best way to grow your account, to make sure that at some point you can take more risk with more risky stocks or undervalued things that you think you found. But you got to build the foundation first and make sure that the bulk of your money can be secured and you don't have to worry about huge fluctuations early on. So the first thing that I would do when you're building your portfolio is get involved in the ETF space. This is the easiest way to invest. Get involved in things like VTI and VOO. Those are companies that fall. VOO follows the S&P 500, and VTI is just a broad stock market index. So getting involved with ETFs and index funds are great for starting because you don't have to do any research or really dedicate time to the market and to companies and news and all this stuff. You don't have to be up to date on all the news and everything going on. You can easily just get started in the market and make sure that when you're putting money in these index funds, it's not going to have huge volatility. You're not going to go up 50% in a day, down 50% the next day. It's not going to be big volatility like that. So it's going to be kind of, you know, slow. It's not going to make a bunch of money or lose a bunch of money, but it is the best, safest way to invest your money and diversify it all at once. So you take VTI, for example. It's a very popular ETF. It's Vanguard's Total Stock Market Index Fund, and they offer a distribute your money around like 3,000 companies that they are invested in. So when you would buy VTI, you're actually buying all of the companies they own and a small percentage of each one. And you get to go up or down. The stock moves up or down based on how those companies perform. So it's self-diversifying, keeps your money safe, and follows like the simple rules. It's low risk, low reward, obviously, but it still can make a lot of money. It's not going to, you know, make nothing. I mean, we can look at the VTI returns for this past year. You can see where the pandemic drop happened, where, you know, the big sell-off was, and then rallied all the way back. So this 19.5% return for the past year doesn't include like the bottom of the drop of the market or even the middle of the drop of the market, where that whole slope down was where a lot of people were investing in stuff like this and were deciding the stock market's undervalued, or this has to stop soon, or a big bounce back's coming. So people who made that prediction made a lot of money. But even if this is pre-drop, it's still up 19.5%. So if you put in $1,000, that would be almost $200 in profit. So that's why I would start with building this. It's not super volatile, even, as well as it pays a good dividend. It pays 1.38 dividend. So you're going to be getting dividends on top of stock gains, hopefully gains, probably gains, but you're going to be getting those dividends, and you can pick to reinvest those dividends, and they will just go back into this company and continue to go to work. That's what I do. I do the DRIP program, or the DRIP, whatever it would be called, in Robinhood, the dividend reinvestment program, and that just reinvest your dividends back into the companies that pay you that dividend. So when you're comparing this to the S&P 500, I think is up around 15% this year. So if you only invested in VTI, you would have beat the market. The market usually is the S&P 500 that people talk about. And you would have beat the market because that got 15 and you got 19.5 on VTI. So you did better than the market by just having VTI. And if you look at this and think that it's way too good to be true, this year was just insane and it's never going to happen again, If you look at VTI's 5-year chart, they're up 108%, and that averages VTI to come out to be about 21%, a little over 21% every year of an average return. So this 19.5% return is not insane. It's not something that's out of the question. It's not like a ridiculous outlier year. It's right on track with what the average is. So there's nothing like insane that happened this year that can't happen another year or next year or this year, next year, and years to come. So we can touch back on why I would start with ETFs and things like VTI or VOO is because it doesn't require all that research and dedicated time to the market. But if you want to get into picking individual stocks or learning about, you know, earnings reports, balance sheets, debt ratios, and that types of things that can affect what a stock should do or future of stocks, outlooks, and all that stuff, then this would be the time where you can take a look into that, you know, get used to it, make your own predictions, you know, go on and do research about Apple or something, or look at their earnings report and all their things, and just watch the stock and see if what you are predicting or what you think will happen does happen. And if it does, then you know you're doing stuff right. But if it doesn't, you can take this time to learn why it didn't, or learn something that you thought would happen, why it didn't affect it the way you did, and you can do this without losing money, which is the best part. So after you build your ETF position, I would say probably like a $3,000 to $5,000 ETF position. That'll be a good foundation to start building up on, something to keep a bulk of your portfolio in something that's not super volatile and something that is a safer investment instead of individual stocks. The next thing I would go into is the mega cap companies. These are things like Apple, Amazon, Microsoft, Google, you know, the trillion-dollar companies, the well-established companies who have been around for decades, who have proven they're profitable, proven that they know how to do business, and proven that they're not going anywhere anytime soon. So these are the safer individual stocks to get involved into. So this is still a portion of where you're building your portfolio, where you're building it, making sure that you're not taking too much risk in losing it all, because blowing up your account makes it, you know, you gotta start all from scratch, and no one wants to do that, and that can turn you away from investing forever, which is not going to help you at all in the long term at all. So with getting involved in mega caps like Apple, Microsoft, Google, Amazon, the big companies, you will get involved into more volatility. They do move more than VTI, so you'll see your account start fluctuating a lot more in both directions depending on what these individual stocks do once you start building up positions in these companies. So you'll get the benefit of having bigger gains or potential bigger gains from these individual companies as opposed to what VTI did, because I mean, we can look at Apple stock and see that for the year for Apple, they're up over 76%, so a lot more than VTI. Very safe investment. Obviously, Apple's just a great the most valuable company in the world, so there's no reason not to own them. They know how to do business. They basically print money. I mean, Apple is super safe. Like, literally on a scale of 1 to 10 of riskiness for stocks, Apple's a 1. Like, you don't have to worry about Apple. They're gonna do their thing and they're gonna keep moving along. So there's absolutely no worry with Apple. That doesn't mean they can't go down for a period of time, but usually if they're down, it's a good time to add to your Apple position rather than be upset that it's down for that short period of time. So you build Apple, you build Microsoft, you build the mega cap companies, you have a good foundation of those, as well as this ETF. You could be continuing to add to this during this time as well. But I would say if you want to flip your portfolio onto more of a riskier side, because you'll move from ETFs to the mega caps like individual stocks, there will be more volatility with them, but there would be greater return. So slightly higher risk, slightly higher reward than just having it VTI or VOO. But if you want to get your money into a more growth mode, a little more risk, you could flip it and have your mega caps have about 75% of your portfolio and then 25% in VTI. So this is still all your massive own foundation, so that it keeps your investment safe. And then when you decide later down the road, you can take more risk and not have to worry about the majority of your account being blown up. So if you're gonna go the 75-25% route with mega caps and VTI, or VOO or index funds, whichever index fund you want. Vanguard is just the established one that everyone uses or everyone looks to. Then you could go to if you do $3,000 in VTI stock, VOO stock, index fund stocks, then you can go to 9,000 growing things like Apple, Microsoft, Google, you know, the mega caps, taking a little bit more risk, but still being relatively safe. So now your portfolio will be a $12,000 portfolio with 3,000 in some index fund and then 9,000 in mega caps. So it'll be more on that trajectory of growth, of compound interest, of continuing to grow long term, and that's the outlook we want. Is long-term outlook is better than short-term. It will always work out better if you plan for looking at the stock, what it's going to be in the next 6 months to a year. That's not even really long-term, but that's like your base outlook on a stock should probably be that about a year to first of all avoid short-term capital gains tax, as well as make sure that your money has time to compound interest and grow and continue to grow along the way on a sound company. But at this point, if you've grown your account to $12,000, which still is a very small account, but with majority in mega caps and index funds, this is a point where you could start to take more risk if you wanted to. You could start getting into the small cap companies, companies that you think have a super bright future that just aren't there yet, or ones that you think might be undervalued that people just aren't looking at for whatever reason. I would still be dedicating the majority of your money, whatever you're putting in per month, per week, per whatever, to like adding to mega caps or adding to index funds. But then take a little bit and put a gamble out there on a small cap company, something you think has bright potential, just isn't there yet, or is undervalued by people missing out on something. So an example of I did this was during this dip and stuff, when everything was going back up, I had already started building a lot of mega caps like Apple, Microsoft. I had my VTI position. I was growing all of this, and I was looking at Disney because they had crashed under $100. And I was looking at Disney, and they were affected heavily by the shutdowns and stuff because obviously their parks were shut down. And then the undervalued aspect that I found by watching, you know, finance YouTubers looking into Disney's analytics, their own like earnings reports, their balance sheets, their own news, basically. I figured that Disney Plus launched there and people weren't even valuing it. People were not putting any effort into valuing Disney Plus in Disney. And I thought that it was going to be a big rival to Netflix. I think that there's a potential for Disney to rival Netflix, and that's why I bought Disney under $100 and took the risk that people are undervaluing it, that there's no way that Disney and Disney Plus doesn't boost, you know, revenue, and then that parks don't reopen and boost revenue even more and can carry Disney to insane heights. And that bet turned out to be right, and I turned out to be right about Disney Plus and how the market wasn't valuing it and was undervaluing it actually. So when their subscriber count came out in their next earnings report, their stock skyrocketed because no one was expecting Disney Plus to have like 20 million subscribers or something it had on the first earnings report. So that's like just an example of how you can look at companies and see where they're undervalued, and if you think that they're undervalued enough where the value that's going to be added is going to be insane. So that's just things that you can look out for once you build your portfolio to a comfortable, you know, place, and it can start to make more and more money. So guys, let me know what you thought of this video. This is basically what I did during the drop, the huge crash of the market. Basically plowed money in, built up. I actually had VTI right before the market crash, and when the market crashed, I decided the mega cap companies are just super undervalued and they shouldn't be here. So I plowed money into things like Apple and Microsoft, and then got into Disney. And then on top of that, got into a penny stock at the time that I thought had insane potential and was right about, which was Plug. So it's just the steps I took, and they all worked out for me great. And I think this year is still going to have good returns for the stock market. Maybe not as insane as this year, but I think it's still going to be a great year. and people should be getting involved in the market with a long-term outlook. So as always, guys, don't forget to smash that like button and subscribe button. We are on the path to 1,000 subscribers. I'll see you guys in my next video.